Okay, well, I think we will go ahead and get started. Thank you all for joining us today. This is part of the CWDL webinar series on key mortgage industry topics for our clients and friends in the industry. Today we have a jam-packed session with some serious experts as we take a look back on 2022. Joining us, we have founder and managing partner, Mark Wilson, partner of mortgage banking, Dustin Pfluger, the newly minted partner of mortgage accounting services, Susan Volpe, and director of tax, John Chekowitz. We definitely brought in the big guns today. So a couple of housekeeping items. Feel free to type your questions in the Q&A section. We will do our best to get to everybody. If we don't, we will ping you afterwards. And with that, let's get started.
Well, thanks, Casey. So I'll just jump in. We'll get started here. Basically, just so everybody knows how it's going to flow today, it's a little bit different than our normal ones where we bring an outside speaker on. Today's just an internal discussion. We'll start off with some tax stuff. We'll cover some different tax issues, what's going on, on the tax side of the house. We'll move on then to the audit and accounting piece of it, to how to prepare for your audit, how to close out year end, some key issues that are coming up this audit period. And then we'll close out finally with just some kind of strategy thoughts and thoughts for 2023, what we're seeing clients doing right now to prepare and whatnot. So I guess with that, we can just jump right into it on the tax side. So just jumping in, I guess, John, why don't you just give us a little background of kind of if there's any new tax legislation that's been passed in this year, recent years, and kind of how it's going to affect our clients, how it's going to affect mortgage companies and the owners of mortgage companies.
Yeah, of course. So there's the Inflation Reduction Act, which was passed here recently. It was signed into law on August of 2022. It's effectively a dramatically pared down Build Back Better Act, which didn't have sufficient support in Congress earlier this year. It has phase-ins of provisions from 2022 to 2032 and passed strictly along party lines, with the vice president casting the deciding vote in the Senate. It increases taxes on some, decreases taxes on others, and overall, there's not too much that I think affects our clients directly, but I'll touch on some of them. There's new provisions for electric vehicles that extended the ability to acquire an electric vehicle and obtain a $7,500 or $4,000 credit for those. It limits the MSRP immediately effective back in August of $80,000 for vans, trucks, and SUVs, and $55,000 for other vehicles. And starting in 2023, there's a $300,000 AGI limitation for getting that credit, but that is not yet effective in 2022. So there could be some planning opportunities there if a taxpayer, for example, expects to have an AGI higher than $300,000. And there's a list of vehicles put out by the AFDC Energy website, and I can post that in the chat so everybody can take a look at that if they like, to see what vehicles are eligible, because some Tesla models did open up. They were previously phased out because they had already sold 200,000 vehicles. Same thing with GM. They had reached their threshold of allowable vehicles. There are also some green energy incentives, among them, energy efficient property in the home, solar projects. That's obviously an older provision, but that's been extended. And for 2023 or 2022, rather, you can still get the 30% credit, 30% of cost credit, and there's no income phase out limitation on that. There was an expansion of the premium tax credit, which is Obamacare, just that it's no longer excluded at income levels above 400% of the poverty line. And then lastly, the Inflation Reduction Act put $80,000 into funding the IRS over the next 10 years. Importantly, there was no effect on the SALT cap, the $10,000 SALT cap, which is effective through 2025. So the pass-through entity election credit for pass-through entities and sole proprietorships can still use that workaround. Just as a reminder, there's a election timeline limitation, a deadline, which is June of 2023 for the 2023 tax year. And we'll send out another reminder this year, like we did this year, a couple reminders to give you a heads up if that's something you're interested in doing. Because
Hey, John, real quick on the SALT cap.
Mhm.
Can you explain that to everyone on the call? They might not know what SALT means on what that is. Maybe you can explain that. So I know we have a lot of clients who've done it last year and going in this year, just as a reminder of what that is.
Yeah, the SALT, state and local income tax cap, is it's an itemized deduction. So if you live in a state that you pay income tax to the state, or property taxes, or any other taxes that you pay that are not income taxes, you can take a deduction from that on your individual tax return. Prior to 2018, it was unlimited. So, for example, people who make a lot of money in California could deduct all of those taxes paid to California. But along with the Tax Cuts and Jobs Act came the $10K SALT cap, $10,000 cap on those expenses. So they developed this workaround, which became effective last year, and allows the business to essentially pay those taxes on behalf of its shareholders and take a business deduction instead of relying on the individual itemized deduction to take that deduction. So
You could deduct more than the $10,000 limit state taxes by making that election through your entity.
yes, but it's not perfectly clear cut. I mean, it's not necessarily like a yes, obviously let's do it. I mean, there's a lot of implications of it, like everything else. Something is going to affect something else down the line, so it should be carefully considered, and weighing the risks and rewards of doing that.
Yeah. All right. Well, thanks. Sorry, I just wanted to pause you there.
Yeah, no problem. And then the other provision, which it's an older provision, but just as kind of a reminder, is the Secure Act, which went into effect in December of 2019. I've had some clients ask us recently about this issue, and essentially the highlight provisions from the Secure Act are that you can no longer stretch withdrawals over the life expectancy of a beneficiary for an inherited IRA or an inherited 401k. So you must now distribute the entire balance over 10 years, which is drastically accelerating income recognition. So just something to keep in mind in tax and estate planning in terms of identifying beneficiaries. And those issues are more prevalent now following that. We're still hearing about that today.
So John, you brought up Tax Cuts and Jobs Act. So is there anything with that, any other provisions in that are changing this year, expiring, whatever, sunsetting, whatever they call it this year, or in the next couple of years?
Yeah, there are. Yeah, there is of course the SALT cap that, like we just talked about. The $10,000 SALT cap is expiring in 2025, absent an extension by Congress. There's also the estate tax exclusion, which was roughly doubled under the Tax Cuts and Jobs Act. Right now, I think it's about $11.5 million per spouse, and it's dropping down to roughly $6 million after 2025. So that's something to think about in terms of estate planning. You can also transfer your exclusion to a surviving spouse upon death to effectively double the exclusion. That's called portability. That's something to just be aware of and know that there's a timeline for doing that. And also think about moving appreciated assets outside of your estate before 2020 or before 2026, by the end of 2025. Because especially on appreciating assets like business equity and so forth, important to get those out of the estate before they start appreciating, because that's going to utilize that estate tax exclusion. So you want to get a favorable valuation on those assets and then get them out of your estate. And then the NOL carryback and carry forward rules. Prior to the Tax Cuts and Jobs Act, there was a carryback of 2 years and forward 20 years. So you could still do NOL carrybacks if you experienced a loss in 1 year and you had higher income in a previous year. You could still go back and reclaim that money. As of the Tax Cuts and Jobs Act, you can no longer do that. Just to kind of clarify, there was a temporary suspension of that during the pandemic, which allowed a carryback of 5 years for tax years 2018, 2019, and 2020. But that is now done as of 2021. And there's a 80% limitation on the NOL carry forwards moving forward. So if you have a loss, carry it forward indefinitely, but you can only use 80% of that going forward. And again, this is set to expire absent an extension by Congress. And I think a lot of people do want to see it expire. It's a pretty, government friendly, not taxpayer friendly rule. And then there's also the $500,000 limitation on business losses. It's called the business loss limitation, which effectively, again, just limits how much you can deduct from business losses during any one given year. It functions very similarly to net operating losses, but is slightly different. Likewise, those unused business losses carry forward indefinitely. So I think those are the highlights.
So let's just talk through a quick little example. Our clients, a lot of them on our mortgage banking side, have experienced substantial losses this year, which likely will create an NOL for many of them. Some well over in the 7 figures and higher. What will happen with those losses this year when they go to file the return? What's going to happen with that? Just for clarification, it sounds to me like they can't carry those back right now.
That's right.
And, which is a shame, right? Because they had remarkable years in 2020 and 2021. What happens to that loss going forward? Did I hear that right? That only 80% will be able to be used against future earnings?
Yeah, that's right. Yeah. So the net operating loss this year obviously is going to produce a net operating loss that's going to be carried forward into future years, and it's also going to produce a business loss limitation that's going to be carried forward to future years. And then you're right, it can't be carried back. And I agree that is unfortunate given the fluctuations that tend to occur in the mortgage banking industry. But it will be carried forward indefinitely and can be used with that limitation, that 80% limitation that I was referring to. So, if somebody has a $1 million net operating loss in 2022 and $1 million of income in 2022, they'll be able to offset $800,000 of that income in 2023 with that $1 million net operating loss, and the remaining balance of $200,000 would be carried forward. But again, all this is set to expire.
It does carry forward. So it's only 80% of it can be used in any particular year.
That's right. Yeah.
Okay.
Right.
So it's not gone forever. It's just gone in the next year.
Yeah. Well, it's 80% of your of the net operating loss that is used in any given year. So if your income is above that, you can still utilize the entire net operating loss. Otherwise, it would just be, taking 80% of it, 80% indefinitely. So, yeah. And again, this provision is set to expire after 2025.
Got it.
Okay.
Great.
Yeah, so let's just kind of just wrapping up the legislation side of things. And sorry, I know I got you out of order there. I saw you pause trying to find where you were at. So sorry, John. But you talked about Tax Cuts and Jobs Act, so I thought I'd jump into that. But so I guess, the last just kind of piece on just like legislation. Any other, additional legislation you see coming, anything in the works or talks, either, I doubt this year, but, late this year, next year. Just any brief update on that.
Yeah, well, there's really probably one major one, which is the R&D deduction extender. Typically, if you have qualifying research expenses, you can claim a credit and you can take the deduction for those in the year that you incur them. With this provision, which was part of the Tax Cuts and Jobs Act, which kept getting extended, it will turn them into deductible expenses to 5-year straight line amortizable expenses. So it's just something to consider in terms of planning. If that does go away, is it worth it claiming the credit, or is it maybe better to take the deduction instead of having to rely on a 5-year amortization period? It kind of, I think it's specific to any individual's situation, and I don't think there's one uniform answer. But another thing to consider about R&D is that it can only be used. The R&D credit can only be used to offset income, offset tax from the activity that generated the credit. So just another thing to consider when planning around that. And the other provision is the expanded child tax credit and dependent care credit for 2021 as part of the pandemic legislation. That those provisions were expanded quite a bit, but they were only good for 2021, and they are going to expire if they're not extended. So may not affect a ton of our clients in a big way. But especially with income being down, it could have at least a nominal effect on some of our clients, and those are due to go away if not extended.
Okay. Well, thanks, John. So let's moving just a little bit, just kind of update some hot topics, that we've all been reading about and whatnot. We'll move into a couple of these. So I guess just starting with just the IRS. We've all, read the headlines with the IRS, what they're hiring. Just give us an update on what they're doing, what you think their focus is going to be, that kind of thing.
Yeah. Well, as I mentioned earlier, there's the Inflation Reduction Act, which put $80 billion into the IRS as part of the passage of that act over the next 10 years. And the plan is for them to hire 87,000 agents and use roughly 57% of that budget for criminal and civil enforcement, which is essentially, examinations, audits, and then 32% for IRS operations support. I think everybody knows that the IRS is just very, very backed up right now. It's projected that they'll be unlikely to replace personnel as quickly as they're losing them. 15% of all auditors, which is 11,250, will retire over the next 3 years. And the IRS attrition rate is higher than the federal government by about 2.5%. So the IRS has effectively been underfunded for years. And of course, this is evident through extremely long hold times, and pretty much everybody on my team can attest to that. The IRS is underperforming. Audit rates in 2021 went down. Roughly 1 in 1,000 S corps were audited in 2021. Roughly 2 in 1,000 partnerships and roughly 4 in 1,000 individuals were audited. So relatively low audit rates. That was about a third of what it was in 2020. So I think they're allocating more staff to try to catch up from the pandemic. Something else just to note that's kind of interesting is the IRS destroyed 30 million paper information returns in March of 2021. So those are like 1099s and 1098s. So as a consequence, anyone who gets a notice or a proposed penalty for late or non-filing of those forms should could of course assert that they did file them if they did, and the IRS would have no recourse because of course they destroyed those returns. So there's maybe some penalty avoidance strategy to consider there. And likewise, the $80 billion of funding, I think it's going to take a long time to replace all those people with well-trained people. So I don't think we should expect to see any major changes with the IRS anytime soon. So I know that probably really affects us more than our clients because we're the ones who usually directly deal with the IRS. But I think it's just important to address that because, they are extremely far behind, and sometimes resolving issues that seem like they might be really simple can take us a really long time to solve those problems just because it's so difficult to reach anybody. So,
yeah, it sounds to me like the budget percentage is in reverse order. You said somewhere in the neighborhood of 30-some% in administrative support, and then a big portion into agents, which is just going to drive more support issues in the long run is what it sounds like to me. So it should be interesting.
Right.
So I'm sure this is a question for people listening, or I've even heard this question. People, don't know the best way to ask this. What do you think the focus of the new audits will be? Are our typical client base at risk? Is it just random? What's your thought there?
Yeah, I think they tend to go after taxpayers who they look at ratios. So they look at what is your ratio of revenue to payroll costs relative to your NAICS code, your business code. So they'll look at things like that. folks who engage in certain listed transactions, I think, are more likely to get audited. And then ERC, employee retention credit, is also one that is likely to generate a lot of attention from the IRS. The statute of limitations was extended to 5 years on those, so they are very likely going to see a lot of attention in the future. But and there's just random audits as well. I mean, it's all very speculative. I would say it's tough to say for sure.
Got it. Well, thanks. So I'm going to change up the order again on you again, because you just mentioned it. Since we're talking about ERCs, that was going to be my next question after this next one. So let's jump into ERCs and talk about that for a minute. I know it's a hot topic. I know, we've been asked a lot, especially recently, is it applicable for us? Does it, apply to us, that kind of stuff? Why don't you just talk through kind of the who it applies to, the risk of, filing for it, that kind of thing.
Yeah. The employee retention credit is a pandemic provision, which granted payroll tax for retaining employees during all of 2020, and then for quarters 1 through 3 of 2021. And there were essentially 2 ways to qualify for the employee retention credit, which was a drop in gross receipts from any one quarter in 2019 to any quarter in 2020, and you essentially have automatic qualifications if you met that drop in gross receipts requirement. But I think a lot of our clients probably didn't qualify for that. They might have looked to see if they qualify on the second basis, which is more of a subjective basis. It's called the full or partial suspension by government order, and the qualification requirements for that are a little bit complicated, so I won't go into it, but I will say that there has been an influx of firms and what have been kind of known to become ERC mills that, have reach out to businesses and taxpayers all over the place. And we've had no shortage of inquiries from our clients about that, telling us, hey, this other firm is telling us that, we qualify for this credit. And then we'll run the analysis and find out that we maybe don't agree with that, and it's a contentious situation because there's a potential lot of money on the table, and I would just encourage our clients and everybody just to use caution and to get educated about what the rules exactly are, and read the provisions and see if it is something that you can justify claiming, because like I mentioned earlier, there's a 5-year statute of limitations on those, and the IRS has already directed a lot of attention towards those, because there's a lot of money on the table, there's a lot of discretion. You don't need to do anything to qualify. I mean, anything formal, I should say. You can just amend a payroll tax return and say that you qualify and get a refund. So it's a very low barrier to entry, and it's very, very attractive. So
to that point, let's talk through it. Say there's a client that it's kind of in the gray area on whether or not they qualify, and they decide to take a position. It's a lot of money. I'm having a terrible year. I can use the cash. I'm willing to go ahead and do it. And at the risk of the IRS saying they didn't truly qualify on down the road, what is the actual risk, so we have the client can understand like what will happen in that circumstance?
Yeah, I mean, assuming it was taken in good faith, but for whatever reason they didn't qualify, then it would more than likely just be late payment. There'd be obviously repayment of the credit in the form of the payroll taxes, and then penalties and interest associated with the late payment of those taxes. So that would be the risk associated with that, which could potentially be substantial. Penalties on unpaid payroll taxes are much higher than the penalties on unpaid income taxes, and they reach their statutory maximum pretty quickly. So more than likely that would probably apply. Because you'd be getting audited much later. So
probably
you'd be
4 or 5 years down the road. Usually audit notices show up right before a statute.
right, and they ask you for that.
That's kind of how it goes.
Right.
Yeah. So I think that's interesting, definitely for clients to consider the risk reward in that circumstance if it's in a gray area. Obviously, if you qualify, there's no reason not to do it.
Yeah, I agree. Yeah. And I mean, it is a subjective thing too. A lot of that alternative qualification, the full or partial suspension it's subjective. So, just document, make sure you have a good report written by, a good firm that, understands it and can, put all the data together for you so you can defend it if you're ever audited.
Yeah. Yeah. And I know there's, like you said, the IRS definitely has that on their target of what to put some of these new agents on. So very good.
Okay. Let's move on to the last couple tax topics here, and then we can move on to audit and accounting updates. I guess let's just talk a little bit about inflation. And, we've talked about inflation. I know it's all over, whatnot, but I guess how, you brought this point up earlier on how to use it to, the taxpayers' benefit. How can it be used to their advantage, or at least mitigate, the damage, caused by, your eroding value of money. What are some thoughts there?
Yeah. Well, I'll just talk about spending on taxes. There's an incentive to spend on taxes later in future years with less valuable dollars. The value of tax deferral is increasing. And so just things to think about when thinking about Roth conversions or thinking about, capital expenditures or other discretionary spending. There's incentive to defer tax bills until later with less valuable dollars by doing things like, under a cash method, deferring, sending year-end invoices, refraining from electing out of installment sale treatment if you're selling a business or selling an asset, accelerate payment of year-end bills, purchasing equipment, making elections to expense what would otherwise be capitalized equipment, contributing to retirement plans and IRAs, and just in general, just accelerating deductions but before the end of the year. Yeah, I think I'll leave it at that. I think there's just in general there's an incentive to defer spending on taxes until later as the value of the dollar erodes.
Got it. Okay. Well, I guess just to wrap up the tax side, any other tax kind of strategies, planning thoughts, anything else you wanted to mention before we moved on?
Yeah, there's the traditional kind of just year-end strategies, which I did just talk about a little bit in terms of accelerating expenses, deferring revenue, fixed asset acquisitions. You can also, do accrual of year-end bonuses. One that is not, it's maybe seen as a small thing, but one I think is really powerful is the backdoor Roth conversion. It's only, $6,000 or $6,500 this year contribution, but you're getting money into an account that grows tax-free and the distributions are tax-free. So, and there's no, limitation on the balance of that account, how large it can grow. So it's something that I definitely recommend. And, especially even for young people too, you put them on payroll, give them some earned income, have them contribute to a Roth, from the time they're very young, and, it can grow to a really big level. So something in general that I recommend. Harvesting losses and gains from either appreciated or depreciated assets, depending on your situation. Of course, if you don't have gains, then capital losses are not very helpful. Most people, I think, know that those are limited by $3,000 per year. But there is also cryptocurrency, which is not subject to the wash sale rules. So you could feasibly, divest of a position on December 31st, then reacquire it on January 1st. For substantially the same price, and you could, it would reduce your basis. You could recognize those losses. So something to consider there. There's the Section 280 Cap A boardroom rents deduction, which I recommend that most of our clients take. I think pretty much everybody's probably familiar with that. And then for charitable purposes, you can make charitable contributions or establish a charitable trust. What are known as the Section 7520 rates are obviously higher now. So the charitable trust approach maybe is not quite as attractive as it was a couple of years ago, but nonetheless, it's still a valid strategy to employ for tax reduction. So I think that's about it.
Yeah.
Thanks, Sean. That was a lot. Thanks for doing that.
Yeah, that was a lot. I know, just some food for thought also on the topic of taxes. We have clients who are talking about M&A transactions and some other things that might be coming up. And there's a whole slew of planning that goes around that. Some special trust considerations, other type of entities that get put together for planning in that scenario. And I think it's not really a year-end planning, but more of an exit planning strategy to make sure that they reach out. And I don't know if you want to add any ideas around that, John. I know how much you love me putting you on the spot on all that, but any thoughts or planning, like maybe recommendations of the top 3 things or so you should do if you're considering exiting your company?
Well,
call John first.
Yeah, of course, like,
yeah,
of course, structuring the transaction in a tax efficient way is advantageous. So if you're being forced into, an asset sale, an equity sale is probably more tax efficient. So you want to make sure you're, negotiating in a gross up. You can secondly contribute your equity to a charitable trust, so that the trust is the entity that's recognizing the income, and you can structure installment payments to you out of the trust over a fixed period of time. So that's a way to kind of spread the income recognition over a longer period of time, minimize the tax burden, and make sure that you're covered with with an annuity for the indefinite future. And third thing,
state related, maybe.
Yeah, that's a great idea. You can set up a irrevocable trust in another state. There's a couple states in particular, Nevada or Delaware. You move your equity into that trust, and you can avoid state level taxation, assuming that the transaction's taxed as a sale of equity and not necessarily a sale of assets, because there could be apportionment issues with the sale of assets. But you can effectively avoid, like, if you're in California, you're a California resident, you're selling your equity, you move it into Nevada, you can avoid the California taxes. You're still paying tax at the trust level at the top tax bracket, but 37% instead of 50.3% is a little bit better deal. And also there's estate planning considerations around that too, getting assets out of your estate. So lots of considerations there. It can get a little bit complicated, but there's a lot that can be done.
Great, thank you.
Thanks. I think with that, Mark, you want to jump into audit and accounting update, and you can take it.
Yeah, I think it's that time of year coming to an end, and there's a lot of planning that goes into closing out the year. So Susan, maybe you can walk us through a few things, what people can do now to prepare for an efficient year end as it relates to their financials.
Yeah, so everyone and listening now in the accounting field hates audit season. Sorry, Dustin and audit team and CWDL, but we do. We get the audit scaries, right? Especially it's December, and we feel like we probably haven't reconciled what we were supposed to. Here's the first thing I would suggest is talk to your auditor. Get your PBC list right away, because that's a good way to start preparing for your year end. Right. And maybe you haven't reconciled, maybe figure out what the auditor wants up front. Give yourself plenty of time to prepare for that. What we suggest is taking that list and just breaking it down, because as you're closing out your November and your December year end, you can prepare for that. Get your balance sheet done, reconcile your balance sheet, get all your bank statements in line, because they're going to ask for it. They're going to make sure that your trial balance, your beginning trial balance, agrees with last year's trial balance. So you do want to make sure that you run that first. What we do see a lot with bringing on new clients is they forget those year-end audits that the auditors did from the year before. So your balance sheet isn't correct. So definitely take a look at that. the stuff you can do now if you haven't done it. We definitely have a few more months to worry about that. Definitely follow, like I said, that list from the auditors. But take a look at your balance sheet and start scrubbing. Reconcile often. I know a lot of times we hear that we haven't reconciled, certain items on the balance sheet. You need to do that. So start it now. Most people right now in the month of November closing, let's get that started. Take a look at those loans up for sale, line of credit, clean it up. If there's any variances, look at it. The auditor is going to ask about it. Make sure those are all nice and clean, and spread it across your accounting team. Take different people, assign different people to certain tasks. Like I said, that list is super important. We always make sure we ask for that up front from any auditors. And then we spread it across our team to make sure that we kind of divvy it out, and so they all understand what they need to do when it needs to happen.
Yeah,
so
and I think
that's super important.
Yeah, and kind of maybe you can walk through maybe what you see as I'm going to use the buzzword you don't like, that I don't like. What do you, from a best practice perspective, what is, it's funny, I'll talk to people sometime and they go, oh, no, it's reconciled, but you look at it and it's not really truly reconciled. And so you open it up and auditors dig in, and then there's all these skeletons and certain balances. Maybe just kind of walk through what does reconciled mean? What is fully, doesn't mean there's no variance, right? I mean, what does fully reconciled mean?
Yeah, that's a good question, because we hear that a lot, like, oh, we reconcile, it agrees, but it's great. A lot of people identify that there's a variance, which is awesome, but you have to fix the variances.
Yeah.
So if there's a variance and a loan's held for sale and that there's a variance there, and that's awesome, that's great but get rid of it. Make the adjusting entry that needs to happen. The auditor's going to ask you to do it. Just do it. Your escrow true ups, your escrows, any of your liabilities, those are huge. Everyone needs to remember that whatever's sitting on the balance sheet is going to end up eventually impact negative or maybe positive into your income statement. So we make sure you take a look at that. Like a reconciliation isn't a data dump from the system. That's not a reconciliation. A reconciliation is some sort of supporting document that you have to tie to. So you want to make sure you do tie to that. And yeah, we love when people find the variances, but you need to do something with those variances to fix them and get them out of that account.
Yeah.
Reconciliation too, is not a GL detail either. We get that, a lot on newer and experienced clients that, hey, they just send us a GL detail. That's by no means a reconciliation.
Data dump, as we kind of call it. Yeah.
Everything on the balance sheet needs to have a reconciliation, right?
Everything does.
Yeah.
Yes. Yep. And it's not too late to get started. I know a lot of people, like I said, you freak out when you hear it's audit. It's only once a year. I get it. But the stuff you can be doing month to month. The one thing we strive for at our company is we're audit ready, because we're balancing and reconciling every single account on a monthly basis. So when it's audit time, it's pretty easy because we've already done it. We're only like 1 month out, right? So we're only worrying about the month of December when audit season comes. But I will tell you that list from your auditor, ask for it now. Reach out to your auditor, have a pre-audit meeting, go over what they're looking for. Talk to them about things that happen different in your company this year, because they don't want to be surprised when it comes to audit season. Talk to them if something, ERC credits, or well, your tax guy, but anything that was different that you had this year that you didn't have last year, discuss with them now, because it's going to help you a lot more with audit. The auditors are going to like it a lot better because they can plan for it. So I think that's super important, to sort of have that open communication with the auditor, which would absolutely help speed it up.
Yeah, and to that point, Dustin, maybe walk through how's the emphasis of the audit going to be different this year as it relates to last year? I mean, obviously we've had quite a change year over year. And Susan, whoever wants to take.
Yeah, no, I mean, I think it's going to be interesting. I mean, we're hearing a lot, we're doing half the amount of volume, it should be easier, which isn't necessarily the case, because, this year especially, we have concepts of materiality within our audit, obviously. But, if you're close to break even, if you're close to going into net loss, if you're close to your net worth, or covenants or stuff like that, materiality changes a lot. So, in 1 year we could add, $1 million materiality number, but if you're, if you're sitting, before we do the audit, if you're sitting at a, $1,000 net income position, well, your materiality effectively becomes $1,000 because you have a covenant that if you go below, $1 in net income, well, so stuff becomes a lot harder to test. There's less transactions, but it becomes a lot harder to test. It becomes a lot harder to look at. There's a lot more judgment that goes into the materiality in a year like this. All of the standard stuff, the fair values, we're going to spend time on, probably no more than other years, but, be looking at how you're valuing your locks, looking at how you're valuing, your loans, your servicing, and there's been some changes too this year. I mean, we've talked to all of our clients. I mean, one thing that's I know relatively new for this year, much more significant is, including discount points into your valuation of your pipeline and stuff like that. So, just to Susan's point, just understanding that earlier, knowing that earlier.
I would say, I don't know if that's new or old, right? That's just means discount points are come back this year.
Yes.
Right?
Yeah.
Yes, exactly. They haven't mattered in years past or haven't been material in years past. Let's say that, but have been throughout this year, or throughout the middle of this year. So, yeah, I mean, I think those are the big things. Fair value is always an issue. I mean, always looking at those, always looking at it's the biggest, it's the biggest, most significant, estimates on your balance sheet. So looking at how you're valuing stuff and how you're, making sure there's not significant changes there. You're not moving, stuff around on that. So, yeah.
Yeah. We're tracking clients and profitability all year long. Unfortunately, and we don't take this lightly. Many are losing a significant amount of money. We've actually had a few, unfortunately, actually go out of business. And so going concern is becoming something that we haven't had to address up until this year. Really, we had maybe a little bit of it in the past, but this year it's becoming more and more of an issue. What are your thoughts? What are your thoughts on going concern and what's going to be required to address significant losses this year?
Yeah, I mean, if we come in and there are significant losses, if you're, getting close to net worth things, I mean, we do need to see some kind of plan that you've thought about it. I mean, this literature changed a few years back. It used to be on the auditor to address it and assess it and do all that, come up with the plan type thing and whatnot, but they've kind of changed it and put it on management. So, management needs to be thinking through that. Just because you have a significant loss doesn't necessarily mean you're a going concern. It's obviously a triggering factor. But you need to be able to, have documented that, hey, here's what your projections are. Here's what it looks like going forward. Here's, we're cutting X number of people. We've already cut X number of people. I mean, all kinds of factors. We have this much cash carryover from, prior years. So our liquidity position's good. Our warehouse lines are waiving covenant violations. If you lose your warehouse lines, we're out of business. And so, I mean, making sure you're in good relations with your warehouse banks, having plans with that you're keeping them informed, that HUD knows, if you've had to report to HUD for stuff. Basically just the basic stuff to think through as you're probably thinking through on a daily basis right now. What's keeping us in business for the next year? And that's basically the analysis we need to see and what's going. And it can be, I mean, it doesn't have to be anything, long and complex, just, going through and bullet pointing, hey, here's what we're doing, here's how we're fixing it, here's what we're thinking towards the future. So yeah, those are probably the main key things.
Is there any key points, or is it just what they feel can help them? Like, do you have certain things you would be looking for?
I mean, liquidity is going to be a big one. Obviously, I mean, everybody's looking at liquidity. If you don't have, fortunately, if there hasn't been a lot of big distributions, there's lots of, cash or carryover, hopefully. So, I mean, that's going to be a big one. If you're getting close to liquidity violations, that's going to be probably the biggest issue. Probably second is making sure you're in good relations with your warehouse banks, and you've been discussing this with them, that they're giving you waivers for violations, whether it's a, net income violation or, few quarters of net losses or whatever the violation is. I mean, those are probably the two biggest ones I can think off the top of my head. I mean, and then obviously just showing a plan, that you have a plan going forward, that you're not, just sitting.
Yeah. I mean, I would add that the plan needs to have a sense of reality and not necessarily built on hope. Like we're hoping that interest rates are going to change, or there's like going to be more inventory all of a sudden.
Yeah.
I think being realistic with what we're going to be facing going into next year, what does it look like? And I think, to your point on warehouse lines, I think if your warehouse lines have turned you off and you've switched over to being a broker, showing a forecast of how you can survive over the next 12 months, even if it is as a broker. So just because you might have a warehouse line turn you off doesn't automatically say that you're out of business, but that you have a game plan of how you're going to survive in this market. And we know plenty of clients are doing just fine, but maybe your plan is, hey, listen, we know we're going to lose $100,000 or a couple $100,000 a month. We have enough liquidity to sustain that. If we see in 8 months that the market isn't changing favorably to our benefit, we're going to do even more drastic things, and so we can make it over the next 12 months. The going concern measurement is always based on, are you going to be here in 12 months? So being able to show a plan that you can do that is kind of the critical factor in that, right?
Yeah, and I should probably add too, I mean, on the going concern, if for some reason we can't get over the fact that we, that there's a substantial doubt about the going concern of the entity, what basically happens is it's a disclosure in the financials and a disclosure in the opinion, just saying, hey, we're obviously working with y'all and trying our hardest. None of us want to issue those opinions or those types of audits. So, but that's basically what happened, Joe. You have a note in your financial talking about it, and that's what we. And there's a couple required disclosures, but that's about it.
All right. Well, thank you. Let's shift gears over to HUD requirements. What's been changed and what are we seeing there?
Yeah, no, I mean, that's a good one. I mean, we've been trying to communicate out, to our clients through these quarters. We've been trying to help them where they can when they've been asking. I mean, there's obviously the stuff that went into effect last year. Real estate's excluded from, your net worth calculation. There's prepaid, deferred tax assets. That's relatively new, but I think everybody's got that from last year now. So I don't think that's that. I mean, the real concern that we've been trying to communicate out to our clients is there's basically two major HUD violations when it comes to financial statements. It's net worth, and if you suffer a net loss of greater than 20% of your prior quarter's equity. So, and it's usually that second one we've seen people violate. I think everybody has plenty net worth right now, to get by, or most people do. It's usually that second, that 20% loss that's greater than 20% of your prior quarter's equity. So if that is happening, again, we've been sending out emails. We've been trying to reach out to people, individually, if we think you're getting close. But if it is, you need to report that to HUD. I mean, HUD, if you report it and you report it and they, you report it when timely, and you have 30 days after month end to report it. So it's usually just okay, well, hey, you need to provide financials for, the next 2 quarters and stuff like that. If they find out that you haven't reported it and there was a violation of that, then that's a much more significant. You're talking about going to like the mortgage review board, talking about, $10, $15, $20,000 fines for not reporting a reportable event. And it is something we have to test in the audit. I mean, it's something we have to go back through and look at, your quarterly financials, making sure there is no net losses. And then the last thing to add on it is just, year-end financials, you're technically supposed to report within 30 days of year-end. So, if you think you're close, or you definitely know you're going to be over, but your audit's not happening until, into February, you should probably go ahead and report. You should probably report, get it in the system, get it reported. The worst that can happen is, it turns around and it's not that, it's not 20%, and, you file and just say, hey, it wasn't as bad because of audit adjustments or something like that. So those are really the big ones, but I mean, just emphasizing that reporting to HUD is necessary, and it is the much better route to take than trying to hide it or keep it from them. So,
do you have maybe a reminder of a couple of HUD letters that came out on acceptable assets that came through? I know that was really prior reporting period, but they added some clarity around some asset classes that are no longer acceptable.
Yeah. And to that point, I mean, to just go in a little bit deeper, what I mentioned earlier. I mean, it's really the big one for our clients that we're seeing is real estate owned, prepaid assets, some deferred tax assets for C corps, but really it's that real estate owned and prepaid expenses. So in real estate owned is basically defined. It's not just typical REO, what everybody thinks about it. It's if you own any kind of property that is not your corporate office, it now gets backed out. So in years past, we'd seen a lot of people contributing buildings into the company to get net worth up and contributing the land into the company, and now that is not allowable anymore, and they're backing it out. So it does good to contribute it anymore because it just gets backed out right away. So
yeah, and it seems to me every single year it comes up, even though this is an old rule, but related party receivables like shareholder receivables, mutually owned corporation receivables, those sorts of things don't help with net worth when it comes to HUD. So just keep that in mind. All right. Another issue that's big this year that had been kicked down the road for many, many years and is officially in effect is the lease standard that that I feel like we talk about on every webinar and we preach about and we beg people to implement, and it's now here. Now it's no longer debatable or kickable down the road. Why don't you go ahead and walk through that?
Yeah, I mean, it is. I mean, again, something else, like Mark said, we've tried to communicate. I mean, we've probably sent out, I don't know, 10 different emails, since May or so. It is here. There is no more delay. It has to be here. It has to be done by, it has to be done for your year-end financials. Good news is we're getting relatively good response rate now from our clients, getting through it and stuff like that. And this is, audit or accounting client, just so everybody knows, because if, we're the auditors, we're definitely gonna be asking for it. If we're not your auditors, we'll be asking for it. And this is not a mortgage industry thing. This is something that any auditor across the country will probably know about. I mean, it's the biggest piece of accounting, standard change in a long time. So basically all it is you have to, capitalize all your operating leases on your books now. So you put them on as an asset, you put them on as a ready use asset, and then a liability on the books, and they amortize off a little bit different. One gets depreciated, one gets amortized off. But I mean, the good news is there's a lot of softwares out there that can help. You could do it in Excel, but it'd be real hard. I think a lot of the accounting firms, regardless of who it is, I mean, we're definitely using its software called Lease Crunch. And they basically, it tracks everything for you, and it's really, really affordable. So it's basically, you plug it in, you spits out everything you need. It spits out stuff for your disclosures, it spits out your journal entries, it spits out what you should be amortizing every month. Very easy and very basic. So
and we can we're helping clients do that as well. So
so we definitely can help. So
all right, well, good. I don't know, does that kind of wrap up that section? Anything else you can think of as we're getting through this part?
No, I mean, I think that's really it. I mean, I think, again, to reemphasize what we started with, audit's going to look a little different this year. I mean, it's going to be different than years past. So yeah, I mean, hopefully we've been talking to you. Hopefully we're getting ready for it. We're going through compliance, getting ready. But I think that's really it.
Great.
So I think with that, we got two more questions we wanted to run through, just with strategy for, what's to come. And actually, we probably could just combine them into one for sake of time here. So I guess, Mark, from your experience in the past and whatnot, your background and, what you see in our client base, I mean, just walk through some thoughts just for, the remaining month of the year, and especially going into 2023, what we're seeing clients doing, what we're advising clients to do, just in terms of strategies on containing costs, that kind of thing.
Yeah, I mean, we've touched on it. Obviously, everybody on the call, I know it's been a tough year. Unfortunately, we're going to see that continue at least through the next few months, or if not longer. So, we've been talking with clients a lot and helping them manage their losses and coming up with a game plan to really help them do that. And recommend, and so as you look at next year and going into it, I don't think hope is a good option. I think looking at how much money you have in the bank, and getting your company to the right size is really important. And knowing your strategy. I mean, making sure you have a strategy. If you're taking losses, knowing that you're okay taking those losses because you have enough cash in the bank, enough assets to support that loss for a sustainable amount of time. I know we have some clients that are investing heavily in growth, trying to get loan officers indoors, make sure you're getting the loan officers that are going to produce, and making really sound business decisions around that. We're not recommending that everybody has to, that you have to right size and get rid of everybody down to the bone, but just being really conscious that this market is likely going to be difficult going into Q1. The MBA had said we're going to be facing, I think, 5.5% unemployment coming up next year, and likely no real break on interest rates for a little while. Although obviously I've talked to a few clients that have a little bit of a better pipeline than they did in the prior month. We'll see where that goes. I think when you're planning, I talk about being a wartime CEO often, is where you're at today, you have a pretty good idea where your pipeline is and how much you're going to close. So you can predict whether or not you're going to be in the black or in the red in the next 45 days or so. Really using that to make really important informed decisions is critical. Looking at everybody in your company and finding out who is producing this time at the right amount versus who are kind of underperforming. It's an incredible opportunity to work on your processes, reward your best employees, and kind of really focus on rewarding those guys that are contributing the most to your company. It's funny. I went to a session the other day, and the guy who started ClickUp said something that was kind of interesting. He had an all company meeting. I have over 1,000 people working for him, and he's a young person. And he said, listen, going into the next year is going to be difficult. And those of you who want to be, who think that work-life balance is important on the life side higher than the business side, that's okay. But in the market that we're facing, it might not be. We're going to be asking you guys to do more for less as we get through this. And that's what happens when markets are difficult. So hopefully our clients will be able to do more for less in the next year or so. And the companies that come out of this at the end will be the ones that will be ready for the next market cycle. So
yeah,
it's a long answer to a very difficult question that isn't easy to answer.
No, I think you're right. I think it's perfect. So I think with that, Casey, you can kind of take us out. We're about a minute out. So
Sounds good. Thanks everybody for joining. Like they've all discussed, 2022 has been a crazy year. I think we say that in the mortgage banking space every year, but definitely not one for the faint of heart. So Susan, Mark, John, Dustin, thank you so much for sharing your insights. If you guys can keep an eye out, we'll send the recording over. We also shoot out a survey just because we want to make sure the topics we're delivering are relevant and top of mind to you all. So if you guys could take a couple seconds to take the survey, it means a bunch to us. Other than that, hang in there. Happy holidays, everybody. Thank you so much for joining today.
Thank you, guys.
Thanks, guys.
Goodbye.